From the opinion pages of the Wall Street Journal, this is Potomac Watch.
The Federal Reserve gets aggressive and cuts interest rates by 50 basis points on Wednesday, surprising some in the market who had expected 25 points of cutting. And the Fed signals another 150 basis point cuts in the next 15 months. What are the central bankers thinking? And does it mean the fight over inflation is over? Plus, how would Donald Trump and Kamala Harris handle the Federal Reserve differently if elected? Would either of them reappoint Jay Powell as chairman? Welcome. I'm Paul Gigot here with the Potomac Watch podcast. I'm the editor of the Wall Street Journal editorial page, and I'm here with two of my colleagues, Mary Anastasia O'Grady and Joe Sternberg, both of whom follow monetary policy and the Fed and the economy. Welcome to you both. Let's listen, for starters, to Jerome Powell, the Federal Reserve Chairman, speak to the press after the Federal Open Market Committee made its decision to cut rates by 50 points.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Well, that was an aggressive move, but the markets liked it, reacting well on Thursday before tailing off by the end of the session. But they have resumed their ebullience here on Thursday with equities soaring on the news of the interest rate cuts. Joe, what do you think the Fed is signaling here about its inflation fight and the state of the economy?
Well, I think what you think the Fed is signaling is going to depend on whether you look at what the Fed says or what the Fed does. Certainly the message from what Chairman Jay Powell said in the press conference yesterday, and really the message that we've been getting from a lot of Fed officials recently, is that the economy is actually in a very good state, has cooled down a little bit from the rampant activity that we saw in the immediate aftermath of the pandemic, but healthy economic growth is still in a good condition. And so really all they're trying to do with this move is fine-tuning. That's what they're saying. The problem is that what they're doing with this 0.5 percentage point rate reduction at one go, which is unusually steep under these circumstances, it is as if they are signaling that despite all of the happy talk, they are somehow worried about what they are seeing out in the economy. And they're afraid that if they don't move more aggressively now, we could be right around the corner from some kind of big economic problem. So what seems to be happening in markets is that investors are deciding that they're going to treat good news as good news. And their assumption is always that falling interest rates are good for equity prices. And they seem to be prepared to take Powell at his word that the economy is still reasonably healthy. But again, there's that lingering doubt because the words are so at odds with the action here.
Well, Mary, there wasn't a note of triumphalism, which I had feared, in the remarks by Powell at his press conference over the fight of inflation. He was asked directly, does this mean the fight isn't over? He said, no, it isn't. We're still vigilant. But it's hard to resist the conclusion that the Fed has pivoted to put somewhat larger priority on the increasing jobless rate, which is 4.2% now nationwide. Not that high in historical circumstances at all, but has been rising. And he must feel pretty confident about the inflation fight.
Well, Paul, the Federal Reserve Chairman has this perpetual problem, which is that he has two mandates, not just one. And between fighting inflation, he also has to ensure what they say is full employment. And that is a really tough needle to thread. And I think if you put yourself back a year or 18 months, there was a strong expectation that by trying to kill off inflation rather aggressively, he would end up killing the economy and the joblessness would go up and he will have missed on that second mandate. And I think the idea that you hear economists talking about this soft landing, which is that we can maintain economic growth while bringing inflation down, was always considered kind of far-fetched. Like eventually there was going to be this recession. And I think if you hear any kind of sort of glee in his voice, he has really challenged the naysayers and the gloom and doom group because so far he's achieved that. So he has to be somewhat satisfied with the outcome so far. Now, obviously it could be those last 10 floors from the jump, that hurt the most. So he's not out of the woods and he acknowledges that. But I think he has good reason to feel rather satisfied. I mean, I know that the markets were shocked about the 50 basis points because most people, I think, were expecting the 25, but I don't think it's that big a deal. What the bigger thing is how aggressive they will go after this and whether they'll end up sacrificing this anti-inflation agenda they have for trying to preserve the economic stability.
Powell said that the risks between inflation and unemployment were roughly in balance, Joe, but I think the 50 basis point cut belies that. I think they've actually tilting now in the direction of unemployment. Maybe that is the right call. My concern is, and it's really just, I don't know what the Fed's internal models say, but as I look at financial conditions across the U.S. economy, I haven't thought that they've been all that tight. You have ample liquidity, have had it. You have had gold price going up. You've had equity markets that have been buoyant despite a recent correction of modest amounts and then back up to pretty close to new heights. So I haven't looked around and said, oh boy, the Fed is really squeezing monetary policy. M2, even if you're a monetarist, you believe in the money supply as the main determiner of prices. M2 has been going back up in recent weeks, and I think beyond that, even some months. So I'm a little concerned that what you see here is maybe being more aggressive than they should be. But obviously, we have to wait and see. But there is that risk that the disinflation fight that, as Mary says, they've done so successfully could halt.
Yeah, I think, Paul, you're actually hitting on a really important point here because their assumption clearly is that they can do the rate cut now, shift their focus pretty squarely onto the labor market, and trust the models that I assume are telling them that on current trajectory, the disinflation is going to continue until inflation gets down to 2%. The problem with that is that for all of the reasons that you just laid out, where financial conditions have actually not been particularly tight throughout this quote-unquote tightening cycle, and yet the inflation has come down, I mean, that suggests to me that something about the economy is not behaving in the way that the models would typically predict. We have had more disinflation than you would have expected for the degree of financial tightness or otherwise that we have had. We've had more disinflation than the Fed models would have predicted given the level of employment and the labor market health that we have had over the past couple of years. That says to me that something might be awry in the models, that there are things going on in the economy that neither the Fed nor really any of the rest of us fully understand. And if that is true, how confident are we that we can predict that if they start a rate cutting cycle now, that disinflation will continue to drift down until they get back to the 2% target? I think that it's this situation of having discovered over the past few years that there are a lot of things that the Fed doesn't seem to understand about how the economy is working right now. And yet, with this move this week, Powell is putting a lot of faith in his colleagues' ability to anticipate what's going to happen with inflation in the future.
All right, we're going to take a break, and when we come back, we'll have more about the financial and political implications of the Federal Reserve rate-cutting decision. Welcome back. I'm Paul Gigot with the daily Potomac Watch podcast here with Joe Sternberg and Mary Anastasia O'Grady. Mary, you watch the inflation numbers very closely, especially the so-called PCE, the personal consumption expenditure numbers, which the Fed stands by. Do you think Powell's justified if, in fact, he has a view that inflation is going to keep going down?
Well, I think Powell, I love Joe's Austrian humility, and I think Powell has been pretty humble throughout this process, which is surprising for a Fed chairman, much different than some of the previous people we've had in that job.
You mean like Ben Bernanke?
Well, I didn't want to mention names, Paul.
I will.
As I said before, I think he has good reason to think he's on the right track. The numbers come down a lot. We haven't tipped into a recession. One of the things that's a challenge for him here is shelter, because shelter is priced into inflation. And there's all kinds of distortions in the housing market in the U.S., and many of them not created by the Fed that have more to do with supply than anything else. So I think he's on good ground when he says, we're going in the right direction. We're going to go month by month and see how prices look. I think the big problem he has, which he's not supposed to talk about, is government spending, which puts a lot of pressure on inflation. And, he's supposed to be independent. He's not supposed to comment on that. But that is a big problem for any Fed chairman, because as long as, what the Biden administration did was throw so much money at the economy, that's going to be inflationary. So he has to stick to his knitting and stick to his job, but always keep in the back of his mind that he's got a problem there, because neither party in Washington is interested in being responsible with respect to spending.
And just to underscore your point, Mary, the deficit for the federal spending deficit, budget deficit for the fiscal year that ends at the end of this month, September, is nearly $2 trillion. And that's when the economy has been growing almost 3% for much of this year. That's unheard of to run those kinds of deficits when you have a healthy economy. And there's no real spending restraint in sight, because so many of the Inflation Reduction Act subsidies are still going through the economy, still haven't even begun to be spent. So that's going to be an ongoing problem for any Fed chairman going ahead. Joe, let's talk about the political implications of this. Here you have a big rate cut shortly before the election, fewer than 50 days to go, in fact, before the election. The rate cut will mean, I think the Fed hopes it'll roll through mortgage rates and make housing somewhat more affordable. And certainly they hope counteract any slowdown in the job market. And of course, the big boost, if the equity markets stay as buoyant as they are, people will feel richer. So the wealth effect, so-called wealth effect, which is impact of rising asset prices on people and making them feel richer and therefore more inclined to spend, which would buoy the economy, that also could be the result of this rate cut and help, presumably, the incumbent party and the Democrats.
Yeah, I think that of the factors that you've just described there, that the last one, this wealth effect issue, is probably going to be the most politically salient, because the reality is that any Fed policy change tends to take a while to filter through to the Main Street economy. So, even on things like mortgage rates or the potential effect on the housing market, it takes longer than you might think for that to be fully felt. So what people will notice is that the markets are going up as we're recording this on Thursday. So to the extent that contributes to people having a better sense of well-being or more warm fuzzies about the state of the economy than they had before, that, might have a bearing on the election. Then there's also this, so there are two issues here. There's voters feel about this move, and then there's what politicians want to think or say about it. And here you can anticipate that Donald Trump is probably going to be very unhappy about the Fed's decision to cut rates so close to the election. In fact, over the summer, he was very vocal about trying to warn the Fed off of doing this. Now, I want to be very clear here that I don't for a minute think that Chairman Powell or his colleagues on the Fed are trying to throw the Fed's weight behind one candidate or another. in this election. But I think that you do inevitably run into sort of a sour grapes issue from whichever candidate or side feels that they're being disadvantaged by this kind of move. And so I think it is going to be incumbent on the Fed to really make the argument for what they've done on the basis of the data that they're looking at.